This is the Retirement Solution Podcast with financial advisor Jon Hicks, founder of J. Hagan Capital.
When it comes to your 401k contributions, should you be doing Roth? Should you be doing non-Roth or pre-tax, as the cool kids would say?
Is that what cool kids say these days?
I don't know what the cool kids are saying. I'm just trying to have
Hold
a
on.
conversation.
The cool kids don't say anything. They text something. They tweet.
They're definitely not talking about
Did they even
Roth
call
or
it tweet?
pre-tax.
I don't even know what you call it. Because it sounds like
Messaging.
if you X someone. Oh, see, that sounds dirty or wrong or nefarious. See, so do people still say tweet? They do, don't they?
Yes.
Yeah.
And they call it Twitter too, because nobody calls it X.
Yeah.
We digress.
Because if you X'd your ex, see, I don't know. I don't even want to get into that any further. We're going down.
Stick to what you know, John. Stay in your lane.
I'm going to stick with what
nerd.
I know.
Hey, not cool kids. Stay in your lane. Let's get back
Put
to
your pocket protector on and get back in line, John boy.
401k contributions. As I was saying, should we put them in pre-tax or after tax? Why would we do one or the other or both? Because apparently that's what Vanguard wants us to do. So
yes,
there are a lot of folks getting close to retirement. They're looking at their 401k balance. Things look pretty good. Maybe they've done it all one way or all the other. And as they get close to retirement, they think to themselves, I'm going to stop doing the tax-deferred contributions. I'm going to go all Roth or the other way around. Vanguard is saying that that's a mistake and that splitting our contributions between both can give us more income flexibility later, especially with unpredictable tax rates.
Yes.
Can you explain the who, what, where, when, and why behind this?
Yeah, I was a little surprised that Vanguard felt like they needed to put a piece out on this. But to be perfectly honest, it's because of the same marketing everyone's hearing out there. Everyone's saying, oh, tax rates are going to have to go up. So because of that, you should put all your money in the Roth. Now, in theory, that may be a smart thing in theory. But here's about in practice, and this is what Vanguard was trying to say. The one thing that we're going to want more of in retirement, because we're not potentially going to have tremendous extra time, right? Retirement is those time. We have hopefully a few really great years or maybe several really great years, but it's not like we have infinite time. We're not going to have infinite resources because we're stopping that job that honestly pays us. Mm-hmm. So the one thing that we can have a lot more of in retirement is flexibility. And that is exactly what Vanguard was talking about. What they were saying is, hey, the only way that everyone wins if you put all of your money on Roth is if tax rates actually go up. But we currently have the administration who's saying, hey, we're trying to reduce taxes. Mm-hmm. We're trying to make them lower. Now, we have no idea if that's going to be able to be the case. In my personal opinion, I feel that tax rates are probably as low as they're going to go. And I mean, I think the tax rates are going to go up. But at no point do I think that everyone's money, all of it should be in one bucket, the tax-free bucket. I think that we should be thinking about, does the math work for us to get a lot of our money into a tax-free account? And I think that most people, the math is pretty overwhelming. Yes, we do want a fairly decent amount of money in Roth or tax-free accounts. Having said that, there are ways that we can exploit the tax code efficiently that really do keep a lot of money, or at least a good portion of our money, in tax-deferred accounts, like regular regular traditional IRAs and 401ks. And there are many different reasons why we do that. For instance, if you think that you might want to buy a lake home before you retire, I think that's a great idea. One of the ways to come up with money for that, if you have a 401k, you could actually take a loan against your 401k to come up with a down payment on that lake house, okay? You cannot do that with an IRA or Roth IRA. Okay. So it's just interesting. So again, there are some things, and again, this is not to tell everyone, hey, you should go out there and get a loan against your 401k. Historically, that's not a great thing to do, but it does give you what? The word that Fidelity or that Vanguard was trying to come up with, which is flexibility. In retirement, we want flexibility. We want the opportunity to increase our income in good years, to maintain our income in down years, and to be tax efficient when it's opportunistic, right? Not every year is a great year to make tax changes. Some years, though, are fabulous at that, and we want to make sure we have flexibility. So as I look through the math, I think that most people, if you've never looked at the actual math on doing Roth conversions, call our team and try to find out if that makes sense for you, because I see a lot of people doing it on their own and the math does not work out for them. And it's a poor decision. And unfortunately, it's going to cost you a lot of money in the long run, and you won't have as much flexibility. So it's really important to make sure you do the math. Once you see the math, it typically will take 3 to 7 years. And this is just what we see in the office every day. 3 to 7 years to appropriately dismantle that tax time bomb to go into Roths. But I think that everyone needs flexibility, and we need money in all three buckets: taxable, tax deferred, and tax free in the end.
Reach out to Jon and his team, by the way. retirementsolutionshow.com is where you can do so. That was an interesting point that you made about the opportunity to have a mortgage loan, the down payment, borrowing from your 401k, because something I do feel that in our conversations, we say a lot of look for all the tax-free money that you can. How do you build up all this tax-free money? But to your point, there are some advantages to the pre-tax, the not yet tax money. Are there other areas that we should consider?
Oh, absolutely. So if you think about it, so the reason why I typically say, and mathematically it holds very true, there is, for most people, a specific amount of money for a married filing jointly couple, roughly 65. I'm just giving you kind of an example.
Sure.
There is kind of a magic number that we kind of want to keep in that tax deferred bucket, which is your traditional IRA or 401k. For most people, it's between $500,000 and $600,000. Why would that be the case?
Yeah.
Well, because when we're retired, we typically don't itemize as much. We typically have a standard deduction. And believe it or not, when we have those required minimum distributions that come out of that tax deferred account, the money that comes out is often eaten up by that standard deduction. So that means that we get a tax break when we put the money into that 401k in the front end. And when we pull the money out, if it is offset by our standard deduction, then that means that we got to utilize the money at a much lower tax rate, or potentially even tax-free. That is amazing. That is truly gaming the system. Now, can everyone get to that? Not necessarily. If you have pensions, if you have so much money in your traditional IRA, like 4, 5, 6 million, it's always going to be so much for RMDs that you're really never going to be able to stay within that standard deduction. But there are all kinds of they're not even savvy. It's just using math correctly with the tax code. And understanding what you want to accomplish. There are ways right now that we can utilize the tax code to help with depreciation, to help offset expenses on rental properties and things like that. So there are so many reasons why we want to defer some taxes for some time, have some of it grow with no taxes ever in the future. And frankly, we still do want money in taxable accounts. Not all of it, not the majority of our money, but taxable accounts can be very efficient for wealth transfer, liquidity, coming up with short-term arrangements for loaning out for family members, for down payments on things. So there's really a reason, and it's usually mathematical in my mind, on why all three buckets, taxable, tax deferred, and tax free, all have a very good home in our portfolios. We just really want to do the math to find out what is best for you. How can you exploit your dreams better by having the right amounts in the right buckets? And that's why we have CPAs and tax attorneys on our team in-house for this exact reason, because it is a lot that goes into this, right? It is a lot of not just planning, but keeping up with the tax laws, keeping up with the estate planning laws, keeping up with all these things. And that's why we rely on those guys to help us out, because as things change, we just want to be opportunistic. It's the best thing we can do, is just to be flexible, to take advantage of things as they unfold.
All right. So we know that there are advantages to both pre-tax and after-tax dollars, and how we have allocated those to different retirement savings account. But you brought up the idea of Roth conversion. So let's talk about that. Somebody that has all of their money saved, not yet taxed, everything's in a 401k or an IRA. They have heard all the buzz about Roth conversions. They say, okay, here I come, 401k.com, roll over, convert. And they just start converting dollars left and right. And then they come to you, and you have to look at them and go, well, here's where things went awry.
Again, it's never the wrong time to do the right thing. So even if someone's been doing a tremendous amount of conversions, hey, it's okay. Just get a second opinion. Because usually when we do things, there's a lot of, again, there's no secrets to taxation. It's just what loopholes, and they're not even loopholes anymore, what rules are we using correctly in order to pay the least amount of taxes in one of two ways, Heather. This is the main thing. And so some people say, Jon, I want to pay the least amount of taxes this year. For the next 3 years while I'm working, I want to pay the least amount of taxes. Well, I'll tell you right now, you probably need to be putting money in tax deferred accounts, so we're not paying taxes on that. Now, other people say, well, hold on, Jon, I see what you're saying. But I really just, like, for the money I've saved, I want to pay the least amount of taxes total from now until the time I'm gone. If I could make certain that I paid the lowest amount, so instead of getting $800,000 out of me over the course of my lifetime, if I could only give the government $200,000 instead of $800,000, dude, I would be all in that. Well, believe it or not, everyone's situation is going to be different, but those are potentially doable. You can either pay the lowest amount this year, probably, or you can pay the lowest amount over the course of your life. Which one is going to be more advantageous for you? Which is why I always say it's really, really good to have CPAs and tax attorneys that have estate planning understanding with finance. It's really good to pull them out of their own silos and put them all together. You know, the new book that I have out now called The Money We Keep is really important because it's exactly about this. It's about how so many people have really good advisors, or they're good on doing the money management on their own. And they have good CPAs, but they're not looking at taxes for retirement. Or they have really good estate planning attorneys, but they're really not talking together. And so there's so much money we lose in the gaps between those various silos. Because half the time I talk to someone who says, well, John, that's a tax question. I'm like, well, right, but your finance guy needs to know how that works. Or, John, that sounds like that's a legacy thing. That sounds like that's an attorney question. I'm like, correct, but it depends on how things are titled, which could easily be an individual or a finance thing, or it could be a tax thing. Very rarely do I find someone that says, oh, yes, I know how my income plan is going to work. I know how my distribution plan is going to work. I know how it's going to go to the next generation. And I know that this is the amount of tax savings I should be doing based on these conversions. Very few people have all that. Our clients have all of that. That's the point. We know where they work together. And again, it's not based on a cookie cutter approach. One size fits all, just, rinse, repeat, lather, rinse or was it apply, lather, rinse, and repeat?
Easy for you to say.
yeah. So instead of that, it's one of those things where we just want to find out, what does that client want to accomplish? Yeah. What's the most efficient way to do it? But then not only is it the most efficient, we need them to be able to stick to it. It's sticking to it. It is the difference between having a well-orchestrated plan that fails and having a pretty good plan that they stick with, so it's fabulous. Big difference.
Jon and his team here to help you figure out how to utilize all of these tax strategies with your savings for the road ahead. Visit us at retirementsolutionshow.com.
Thanks for listening to the Retirement Solution Podcast with Jon Hicks. Begin the conversation about your savings plan with Jon and the team at J. Hagan Capital by visiting retirementsolutionradio.com. Be sure to listen to Jon's radio show, The Retirement Solution, Saturdays at 8 a.m. and Sundays at 9 a.m. on News Radio 840 WHAS.
J. Hagan Capital Incorporated is not licensed in all 50 states. To find out if J. Hagan Capital Incorporated is licensed in your state, please call 502-690-5635. J. Hagan Capital Incorporated is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. By contacting us, you may be provided with information about insurance and annuity products offered through J. Hagan Capital, LLC, NPN number 188279094.